on the Monday spaces. I figured you'd come on and share some insight with us here. And Michael, welcome back.
Hi, everyone.
Yeah, thank you for the opportunity. Was excited to get the invite.
Hi, everyone. I have about an hour because I have another meeting. I have a hard stop in about 59 minutes. So, the Swiss way, they don't like they don't like late stuff. So, I'll just hang out for an hour if that's fine.
Yeah, no doubt. Completely understand. I wanted to get Joe to get in here, and then we can get started.
All right, and we got the stream up and running. We'll have a nice recording on YouTube as well, since Spaces doesn't save them forever. So whenever you're ready and everyone's here, Noah, you can kick it off.
Yeah, we got some strong speakers. I know that Joe has a lot to say on this subject, but I'm going to go ahead and get started because we are a little bit past the top of the hour. Obviously, guys, we've been hearing more and more about proof of reserve as this fiasco unravels, and I decided why not do an episode on it, get some people's insights, get some professional opinions or even unprofessional opinions, depending on who you are. But for audience members that don't know, I'm not going to assume a proof of reserve from my research. It involves taking a cryptographic snapshot of assets held by a centralized exchange. So it's important to note that POR is supposed to be done with the help of a third party or protocol. And according to Coin Bureau, most exchanges are working with the blockchain analytics platform Nansen for the PORs. And Nansen is then publishing their exchange holding page. And proof of reserve is also supposed to include liabilities of a crypto exchange, which is essentially the coins and tokens of their customers that they're holding, which is what FTX did not do, which is why it made it seem like they had a lot more money on their balance sheet than they did. So with all that said, a lot of exchanges are putting out their proof of reserves, and still raising a lot of questions like who's auditing these, when is the snapshot taken, and whether this is enough to instill trust, even if they do proof of liabilities, even if they do cryptographic proof of reserves. Is this enough to instill trust back in the crypto community? I don't want to hog the mic. I usually do this opening and pass the mic to whoever has their hands raised or whoever wants to speak. I know Michael's big on centralization. I mean, not big on centralization, but Michael foresees a future where people are going to be interfacing and investing in crypto assets through centralized platforms. He's made very strong points for that in the past. Michael, is this going to be a bump in the road, or is this going to be a shift in trajectory, you think, with respect to a lot of public investors losing trust in these centralized entities?
So I have a lot of thoughts on this. To start, I would say that there's sort of a fundamental problem with centralized services. That is, they rely on people. So if you don't trust people, at the end of the day, you can't trust centralized exchanges. So no matter how sophisticated the proof of reserves, in my opinion, if people are the ones that are custodying your assets, you have to trust the people, because there's always a way to manipulate the system. There's always a way to find, a backdoor around the proof of reserves to essentially be a criminal. So if you're going to rely on centralized exchanges, in my opinion, at the end of the day, proof of reserves doesn't really mean anything if you don't trust the people. So I believe that for centralized entities, there has to be an element of regulation. There has to be an element of trust with the individuals and a track record of trust with those people, and they need to be held accountable. And to me, that's far more important than some sort of proof of reserves. I think proof of reserves maybe makes more sense for some sort of like pseudo, decentralized, partially centralized system where people want to be able to audit their assets in a somewhat autonomous way. But again, if you're going to be trusting somebody at the end of the day to manage your assets, you have to trust the person. You can't rely on trust in some sort of proof of reserve. So I can go into sort of more depth as we have the discussion, but I guess that's sort of my initial thoughts that I would like to share.
Well, you brought up some interesting points here, and I don't see any hands up, so I'm just gonna. Anytime, guys, you want to chime in, go for it. Otherwise, I'm just gonna keep talking, and I can ramble for a long time. But you said that. Well, you said that you need to trust the person, and I'd make the argument that a lot of people trusted SBF, and there are a lot of others in the industry that have been trusted in the past, and they've been let down. Right? That those people have ended up being corrupt individuals, and as a result, thousands, if not millions, of people have lost money in the process. So, how do you set up a centralized entity with not just, let's say that you have a centralized entity that everyone trusts, but how do you hold them accountable at the same time? What needs to happen? And KG, I see your hand up. That was directed at Michael, but Michael, if you wanted to respond, I can grab KG right after.
Yeah, so just briefly, to me, I think first regulation is how you keep these people accountable. So SBF, for example, was not held accountable in any way from any regulators whatsoever. He just bribed his way through the system, and nobody, audited his books. Nobody was looking at what are these people doing in the Bahamas. Like nobody took the time to do anything. So, in my opinion, I agree that there's been a lot of people who've taken advantage of the system through centralized entities, but I guess my argument is that proof of reserves would not have changed anything. So let's take, for example, FTX in Alameda. Let's say they had this proof of reserve system. It was very sophisticated. It showed where everybody's money was, etc. They could just lend assets to Alameda off the books, and then all of a sudden the system's meaningless because they're doing things behind the scenes with other criminals, and it doesn't matter if you have proof of reserves. It's all just a lie to keep people engaged with the platform. So in my view, if you're a criminal, you're going to find a way. It doesn't matter if you have proof of reserves. It doesn't matter if you have all of these checks and balances. You need essentially regulations, government regulations, to sort of enforce those things. At least that's my opinion, but I'm happy to hear what other people think as well.
We got KG and then Yusuf.
Can you hear me okay?
Yeah, man, loud and clear.
Okay. I have to ask because sometimes Twitter's funny. So I actually couldn't agree with Michael anymore. And I believe that, yes, criminals are going to find a way to criminal. And I would actually raise Michael one point and say that even with government regulation, I don't think it would change much at all. Sure, it would hold the honest person more accountable, but the honest person is already honest. So the solution is don't hold your crypto on centralized exchanges. That's the solution in all of this. Centralized exchanges are the exact antithesis of what cryptocurrency was invented to solve. And we're circling back in and saying, yeah, let's adopt the exact thing that we were trying to get away from. With that, I will put an asterisk and say, at this moment, at this juncture in the crypto universe, centralized exchanges are a necessary evil because we still rely on the fiat systems. I can't go pay my car bill in Bitcoin. So until then, if you have to use a centralized exchange, get your fiat in, get your crypto out, or vice versa. I literally hold my assets in a centralized exchange like a hot potato. I want to be in there like the least amount of custody. Learn how to hold your own keys.
I have a lot of thoughts on that, KG, but I'm gonna let Yusuf. We have some hands up. Only Yusuf and then Joe go after.
Yeah, hey now. Essentially, I just want to say pretty much what KG said, that cryptocurrency was developed to be decentralized, not tied to any centralized entity. and I believe it's quite ridiculous due to the sheer marketing power and the volume of new users into cryptocurrency that we've forgotten about the true aspect of cryptocurrency, which is decentralization. Cryptocurrencies were never meant to be held in exchanges like banks. Exchanges were initially meant to be used as swapping tools, so you could put your crypto on an exchange, swap it out, and then bring it back into your cold wallet. I forgot the statistics now, but I was looking at them over 2 weeks ago, and I could see like when early Bitcoin adoption occurred, like the majority of people held their Bitcoin on cold storage, but now it's a vast majority of people hold their coins in exchanges. And the issue is a lot of people are treating exchanges like banks. But the thing is, it isn't really a fair comparison because at least with a bank, they are FDIC insured, or in the US you have your own insurance up to $100,000, and even if the amount surpasses the $100,000 mark per person, then they'll always be bailed out unless it's like 2008 2009 financial crash situation. But I think the major issue, yes, there is regulatory issues that cause a lot of basically like crypto exchange runs. But I think the biggest issue is too much trust put into exchanges. These people, like these Sam Bankman-Frieds, shouldn't have the opportunity to trade with people's funds. They should be left with very little liquidity, just enough to basically keep their order books filled on their exchanges. But they shouldn't be having an excess of user funds to trade with. People should keep their funds on decentralized wallets, on hot wallets or cold wallets, and whenever they want to swap their crypto, they should send it onto exchanges. Like I understand there's exceptions for people who are like day trading. They need fast and quick trades that sadly decentralized exchanges don't currently offer. So what should be done is they should keep a majority of their funds on cold or hot wallets and just whatever they need to trade and keep on exchanges. But by keeping all your exchanges, all your funds on exchanges with the mentality, oh, I trust this person, is too big to fail, etc., you will lose your funds, like has happened before with Mt. Gox, with FTX, with countless other exchanges. So I think the only real solution, no matter how much regulatory involvement gets involved, is to just keep your coins off the exchange. Only put your coins when you need to transfer into fiat or something, because it takes 20 minutes. With faster blockchain, it can take minutes or seconds to send funds from a hot wallet to an exchange. So it isn't that much. I would rather lose out on a trade if due to a 10-minute transfer speed, than lose all my funds due to an exchange collapsing.
Thank you, Yusuf. James, the mic's yours.
Yeah, I mean, I agree with everything that's been said, but I would also add that there's just if we're going to get some of the traditional finance TradFi money into the crypto space, they said it's a necessary evil, but also even then beyond just people's personal money, if people are going to use this, if you're going to be an institution using this, there's going to be safety controls set up. There's going to be centralized institutions controlling these things, and I think it just needs to be better regulation around those centralized institutions that are actually doing this. So if you're a centralized institution and you're using crypto in the on-ramp, you can't just have one person controlling the private keys. Obviously, there's multi-sig and all these different things. So there are going to be centralized institutions doing this. It's just that there needs to be smarter, better regulation around how they are doing this. And obviously, FTX is a perfect example because they were offshore, not really regulated by pretty much anyone. There was no due diligence done on them. And you just have to hope that if we see something like the Coinbases and Geminis, these people that are much more regulated under U.S. laws and the Securities and Exchange Commission and all these different things, that some of these companies that have those regulations surrounding them will hold up a little better than these offshore exchanges. And obviously, there's going to be like I don't know what the exact solution is, but just pointing out that like there's always going to be the need to do this. But if you're an individual, there's no reason to be holding your stuff in an exchange's hot wallet. You should just be able to learn on how to take your own coins into cold storage.
Let's go theory next. How about pronouncing that correctly, by the way?
Yeah, it's Thierry. Can you hear me okay?
Yeah, loud and clear.
All right, cool. So let me go into a rant a little bit, right? So there's many points I want to mention. So the first one is when it comes to exchanges, they also have the ability to enter digital entries because they're a centralized entity. So their system is off chain. So they can basically say statements a la Madoff saying you have these many bitcoins, and then on the back of that they can make up stuff. So this is the first problem. So if you want, the conclusion of this is there must be a proof of reserves in a decentralized way, in a public blockchain, because otherwise it's not real proof. It's just you're relying on third parties' trust, right? Second thing is the proof of reserve is one thing, but then you also have to match it with the proof of liabilities. Because if you have this many reserves, but you have even more liabilities, then you're still insolvent, you know. Then finally, you have problems of governance. So ultimately, you need to also prove not only that your reserves are there, but that also that the assets are segregated, clients' assets versus your own assets. And so this is a governance problem that clearly failed at FTX. So and even deeper than that, once you've proven your reserves, a lot of them are discounted. So in the normal banking system, you have a certain risk ratio for which you have tier one, tier two, tier three. Certain things have different risk, and so therefore they are discounted a certain percentage because their volatility is different. And so what I'm trying to get here is that, number one, those reserves don't mean that they're valued mark to market, because you should be discounting them according to the risk. Number two, their price, and this is valid for 99% of the coins, if not 100, given the pump and dump, fake liquidity, spoofing, and front running that the exchanges themselves do, the price is basically set by the exchanges. So there's a lot of people who say, well, when you put the Bitcoins there, they can basically run the price down or do a flash crash, take all the orders on the stop losses, and then buy them back theoretically because they decided that there was a flash crash, pick up the Bitcoins lower, and they just make the profits. This is not proven, but it hints you the fact that the only people who really made money in this industry are the exchanges. You look at the Bloomberg billionaire list, you see CZ, that is the richest guy in terms of Bitcoin, even more so than Satoshi. The second guy was SBF, and then you have all the other exchanges. So what I'm trying to say here is that not only the collateral, and even for stable coins, because they say they're one-to-one, but I really doubt that they all are, and most of them are backed by discounted shitcoins or bitcoins or commercial paper sometimes. So what I'm trying to rant here is that it's all fugazi, and there's just the layers of shitcoins. So the layers of shitcoins on rack and rack and racks on shitcoins is ultimately telling you that because the price discovery, meaning the fake volume, and 90% of it is fake, you cannot actually accurately tell what the reserves are. So my conclusion is they're all shitcoins, including Bitcoin and Ethereum, and I know I'm going to get a lot of shit for it. And the tragedy of this thing is that the ones that are considered safe haven in the blockchain industry are backed by fiat, which is completely contradictory to the idea of Satoshi, which was an alternative to fiat. And so even those like all of these stable coins backed by USD, not only they depend by nature to the US Treasury, so they can basically wipe you out as soon as they send the Fed coin, but they're not even backed one-to-one. They have yield and like, how can you do 10% on DeFi even? So this is valid for DeFi collateral, for protocols, and even for standard banks. And then the biggest elephant in the room is that once you go through the layers of shitcoins and non-collateralized things, the dollar is not collateralized either, so it's also a shitcoin. So my opinion is Bitcoin is a shitcoin, but at least it's cash, peer-to-peer electronic cash system. It's not money, but the virtue of Bitcoin versus the dollar is that you cannot print more. So in a way, it's got a little bit better than that. But as far as I'm concerned, it's all layers of fugazi, one on top of the other. So my conclusion of this is, even in terms of ownership, one, it has to be decentralized when it comes to proof of reserves. Two, not your keys, not your coins. If you haven't understood that by now, whatever your keys, your coins are at risk, provided it's a central entity. And you cannot blame anybody after what happened. You need to take your keys in your own ownership, create an enormous purge so that everybody fails, and then those who have done the things properly, you'll be able to go back to those exchanges. But then again, you can keep your treasury on your own custody if you can, and then you treat the market like a whore, in and out whenever you need to trade. but that's pretty much it. You know, the elephant in the room again is that even though this entire business is just growing and basically trying to sort itself out, the standard traditional banking system is even worse. So that means that you have an 8% fractional reserve banking. I think in the US it's even 0%. So what we're talking about, like in this chat, is take your coins out of the exchange and they will still be yours, and then you will be able to put them back. If you do that in the traditional banking system, you would collapse the entire system on a run bank in a day or two, and it wouldn't be allowed to happen. So this system is actually better because you can actually have your true ownership, and it's not that leverage if you do it correctly. But I think ultimately regulators are very afraid, because if we're starting to prove and question the reserves in the crypto market, if we do it in the traditional market, then you have 800 trillions with a T of derivatives for which the leveraging will be so bad that the entire world will go into an apocalyptic situation. So that's pretty much what I have to say.
Okay, well, hot take. Bitcoin is a shit coin, but it's the best shit coin. I'd love to have you unpack that more in another space. If I was a betting man, I'd say that Joe and Michael, who've had their hands up patiently, have a lot to say. So I'm going to pass the mic to Joe first. And Michael, Joe, welcome to the panel.
Thanks, Noah. Good to be here as always. I'm going to let that one just kind of simmer a little bit, what was just said, because obviously a lot of us have differing opinions on that and don't agree either in part or in full. And I am going to talk about instead, get it on topic again, proof of reserves and kind of what they do mean to the industry, since that's what we're kind of addressing here. I think it's interesting that some people are so polarized, and everyone is really polarized in the wake of what's happened with all these exchanges, whether they're centralized or decentralized in the last year, really even 6 months. And I think that there's something very important that was said a few speakers ago. I forgot who said it, but it's, do you trust the people behind the exchange, right? And that's an important thing when building your team. I run a admittedly centralized exchange. It's a Binance cloud white label product, but it's independently owned. And there are a lot of safety protocols in which we cannot do and have been intentionally implemented. So we cannot do, just to address that for a minute, what FTX did, right? For instance, all of our user deposits go into Binance wallet infrastructure and are held in one wallet that we cannot access and cannot use to leverage, trade with, or do anything else improper with. And all funds are accounted for on a daily basis. And, then they sit, right? They're there. Number one. Number two, we are not given and have not leveraged our token in any way, our native token, and not given it out, not loaned it out, not done anything with it except keep it in a reserve and keep it in our market maker account for our token on exchange where people trade. And we only access, as other people have said properly, fees that are earned from trading or earned from our market maker account. So there are multiple levels of, and protocols set to ensure that our exchange is safe, solvent, and is only real income and real trading volume recorded, right? Does that mean we're the most successful exchange around? Right now, admittedly, no, but we also don't inflate our numbers, right? So our true numbers are just that, true numbers. And I think it's important, like I was saying, to come back to this, is when you build your team, I built my team myself. I've been a lawyer in the US since 2008. So I've been doing regulatory and compliance work, and I work very closely with state and federal legislators to help draft bills that are beneficial for the whole crypto industry, right? And that will give proper oversight. And it's something that I take pride in, because there needs to be levels of oversight, whether it's centralized exchanges, decentralized exchanges and ecosystems, or DeFi bridges where there's rug pulls all the time. I mean, it doesn't matter. There are bad actors in the industry. We know that. And it's not just from one side of the industry or another. And, for instance, myself as a CEO of an exchange, I'm not going to risk my law license to steal money. I don't care what amount of money it is from other people or improperly use it. And I instill that in my team as well. And we have proper oversight to make sure that our team, top to bottom, all 10 or 11 of us that are, full-time at our team, do not ever have access to those funds or the ability to do that. And that was a huge oversight with, FTX. and all these other exchanges that, like, whether it's centralized, like I said, or decentralized, like BlockFi, Celsius, whoever, that were, loaning out and lending out at unsustainable rates and making trades in the background with user funds. That's just a big no-no. Sorry. The market should, this is all about decentralization, right? The crypto industry was based on that, and it's about ownership. And what we think part of ownership should be was letting the market and letting individuals set the prices for these tokens, right, that are traded. We don't want to have any hand in that unless we're trading as individuals, and we never will. That's number one. Number two, and I think even more importantly, it was addressed, is that CDFI is absolutely going to be the way this industry moves forward in the future. There's no DeFi versus CeFi. Yes, there's pros and cons to both, but they're both going to exist regardless of philosophies, and they are both going to have a prominent place in this industry. And that has to be understood and recognized by, I don't care who it is, whether what side of the aisle you're on, CeFi, DeFi, it doesn't matter. TradFi, I don't care. You have to recognize that, number one, if this industry is going to succeed, proper regulation and partnerships and cooperation needs to happen on every level. There were so many failures that that happened, and so many check marks that weren't ticked off, whether it was the accountants and legal team for SBF and FTX's web of companies, whether it was the executives themselves that were manipulating people's funds and basically committing fraud and embezzling, or other levels of protocol regulators that weren't overseeing them properly, right? Because they were slow to adapt, like we've seen in the US in relation to the rest of the world, which is what we're trying to fix actively. And it hurts the industry as a whole when things like this happen, as we know. It doesn't matter what kind of protocol is being used or what kind of protocol you are in favor of. So moving forward, what needs to happen, and proof of reserves is a start, but I agree that proof of reserves is a piece of it to show that you have those assets, but then to also show that you're not leveraging those assets or showing that you're not using them in an inappropriate way, and having them audited, in wallets that are verifiable, whether it's every month, every quarter, I don't care, but it should be done, and companies should be taken to task, because listen, we're in a really tough industry as it is. It's very tough to gain headway, and when a bear market hits, it disproportionately affects crypto companies over traditional finance companies that may lose 2, 3, 4%, 5% maybe of their stock value, but they still have reserves to pull from and a lot more established businesses to pull from. We're all still startups in this industry. People have to remember this industry is only 13, 14 years old. It's nascent, right? So we have to band together and do what we can, and proof of reserves being a small part of it, to get to a level where it's mainstream accepted, and that won't happen unless everybody cooperates. That's all I got to say.
Mic drop. Michael, you're up next.
Yeah, so there's a lot of thoughts here. The first thing I would say is that I think we need to. There's a lot of sentiment right now in the crypto space that everybody just needs to do DeFi. And I understand the ideals that were sort of built into the market and why people think that DeFi is the only way to go and all of these things. But I think we need to realize that that's impossible. It's impossible to convince every single retail person to use DeFi. It just won't happen. So we need to live in the realization that there's going to be CeFi, there's going to be DeFi, so we need a solution for CeFi sustainability. And the only way to have that is, unfortunately, through regulation. Although people don't like regulation, talking about regulation, I think that's the only realistic path for us to have sort of a safe and sustainable CeFi ecosystem. Because at the end of the day, everybody can push, just, own your own assets, have your own keys, manage everything through DeFi solutions, and you'll be fine. But people have full-time jobs. They don't want to spend hours trying to figure out how to manage their assets, or they don't want to fear that they're going to lose their crypto because they used some shady smart contract, and it collapsed, and now they lost all their money. So I think we need to sort of accept that both DeFi and CeFi are here to stay, and there's nothing that anybody could do about it. Anybody can start a new centralized exchange. Anybody could start a new centralized service. You can't stop them, and retail investors are going to use them. So I think we should try to shift the conversation towards how can we have a safe DeFi environment so that people can not fear for losing their assets, and the people who want to self-custody can self-custody, but also people who are using CeFi, how can we make sure that they're secure as well? They're not, at risk of losing their funds to some criminal like SBF. So I guess one of my core opinions is that we don't really have the luxury of just saying just do DeFi. It's not that simple, I guess.
See hands up. Yusuf is first, and then we're gonna go to James.
Yeah, I just want to essentially say that I think a lot of things, going back on Thierry, were completely right. Basically, there's proof of liabilities and proof of reserves, and there's a lot of exchanges that have published proof of reserves, like even Binance, who's basically the one who's led this revolution of proof of reserves after the FTX situation. But I think the irony of this is Binance is one of the only exchanges that's posted proof of reserves, out of the ones that posted proof of reserves, but they haven't posted proof of liabilities. And without proof of liabilities, the whole thing is completely and utterly useless and redundant, because basically, if I want to explain this basically on like a balance sheet basis, proof of reserves basically means how much money you have across all your wallets, and proof of liabilities basically means how much you owe to customer credit. So proof of liabilities basically means how much of that money in the wallet are customer funds and how much are your own funds. But Binance hasn't posted any proof of liabilities. These are like, oh yeah, we have. I'm sorry, I apologize, I forgot the exact amount they said they had. Something billion. Like, oh, we have this much billion in proof of reserves, but they haven't posted their proof of liabilities, which could mean that their proof of liabilities supersedes, in worst case scenario, their proof of reserves, that they owe people more than they actually have. So proof of reserves is actually redundant. They're just trying to show off a number and be like, oh, we have this much amount of proof of reserves. So I don't think proof of reserves enough is alone to basically say, oh yeah, we have this much. Even Kraken and Gemini and OKX, and a lot of other competitors, they've posted proof of reserves and proof of liabilities. The issue also with something like OKX, and they posted proof of reserves, but they only posted proof of reserves for their biggest coins. So like BTC, I mean proof of liability. So they posted a proof of liabilities and reserves for BTC, ETH, and USDT. And it's like at a 101% proof of reserve to proof of liability ratio, which means they're only 1% over collateralized. And the reason why it's bad, they only the proof reserves, proof liabilities for those top three coins, which means if someone exchanges their shit coins all into BTC, then it might be 103% liabilities and 101% reserves, which means they'll still be in debt. So I think it's quite funny how, I just want to bring this up, how Binance was the one who's pushing this whole charge for proof of reserves, yet they're still hiding their proof of liabilities, and they claim if you search it online, why they don't have any liabilities. CZ claimed they have no liabilities, but this doesn't work on a balance sheet basis because any customer funds are liabilities, technically. But also, I want to go back on another point where someone stated that regulation is the main issue when it comes to centralized exchanges. I think, yes, currently centralized exchanges are going to be the dominant force when it comes to traders because decentralized exchanges are still so far away. They're very, very recent. If crypto's 13 or 14 years old, then DEXs are like what, 3-4 years old currently. um Once they evolve to like within 5 to 10 years time, then they'll be utilized for day-to-day trades. They'll be much faster. Like Ethereum will have sharding, and also the other blockchains will be more scalable, and they'll be cheaper, hopefully. So I think eventually decentralized exchanges will be the common thing in crypto. But I think also it isn't just regulatory oversight that's an issue. I think it is a lack of education, not only the consumer side. I've talked about the consumer side a lot. If you're still in crypto and you don't believe keep your keys, your keys, your coins, then you should honestly get out of crypto, because that's just one of the main rules you should abide by. It's your keys, it's your coins. If you put them on an exchange, you lose. You don't own those funds anymore. But I think so that's the consumer side lack of education. I think there's also lack of education on the regulation side or the fintech side, because currently a lot of people in fintech, they are uneducated Neanderthals when it comes to cryptocurrency. If you look at FTX, basically how FTX succeeded with their whole structure, they were using something called a flywheel structure, which essentially they created the FTT token, they pumped the FTT token, and they marked the pumped FTT token as gains on their balance sheet, and then they showed people like I don't know, like Goldman Sachs type lenders that, oh look, we have an exchange and the token is pumped, and you lend us money, and look, we have excess of liquidity, and then they get lent money, and then they're trading with this lent money, and then the creditors don't know they're in deep shit because they have a bunch of debt compared to actual liquid assets. So on paper it looks like they have a lot of assets and their assets supersede their liabilities, but in reality a lot of those assets are illiquid, because yes, technically they have the assets but they're not liquid. So I think there needs to be greater regulatory information, and fintech information. So before they're lending to these crypto exchanges, they need to really look into the token. Like, okay, did they pump their own coin? Are they trying to do a flywheel structure? Really, what am I getting into? Because currently, it's just they're throwing money left, right, and center when they hear the word metaverse, crypto, etc. So I think it isn't only a lack of education on the consumer side; it's a lack of education on the fintech side, banking side, etc. I think overall, I think education is the main issue before regulation, and we can even see this in Nexo's case. If anyone is familiar with Nexo, basically they have basically like an online self auditing thing. You can go on their website, and you can basically see the reserves, and you'll be like, oh, we're back to even more 1-to-1. We're back like 2-to-1 or something. But in fact, if you actually look at their balance sheets, most of those backing is in Nexo coins, their own token Nexo. And the reason why Nexo hasn't collapsed, like Celsius and Voyager, is because Nexo had no exposure to 3 hours capital. But this will happen again in the future. If there's another bull run, there will be another 3 hours capital, and that will collapse because there's always going to be a ridiculous traders that do good trades, and a lot of people invest into them. And then once Nexo invests in a 3AC, then Nexo will become insolvent, and then you'll be like, oh, whoopsie daisy, all our backing is in Nexo tokens. We can't actually let you withdraw your funds. And I just think that's why overall I think education is the biggest issue when it comes to cryptocurrency. Yes, regulations need to be imposed. Yes, more people need to move to decentralized exchanges. But I think with proper education, people will know about the risks and not just blindly throw money when they hear the word cryptocurrency.
Wow, obviously lots to unpack there, James. I know you've had your hand up for a while, so I'm going to go with James, and we can move on the list.
Yeah, so I'll say just to be like the Alameda FTX situation. I mean, if you look at it, I mean, who knows how much longer this would have went on if we didn't have DeFi? Because there was a lot of sleuthing that went on after after CoinDesk broke the article and leaked a part of Alameda's balance sheet, and everyone could see something was fishy, and then you could see a lot of movement on chain, and then you could see their one wallet stopped meeting withdrawals, and there was a whole bunch of things here, and maybe this could have gone on for years longer if we didn't have the DeFi side of this. So I would point that out as like one strength for DeFi, but the other side of it is like if you some of this stuff, it's very idealistic. Like I agree with pretty much everything Michael said. Um, you have to live in reality and what's practical at this moment. And if most people don't want to have to deal with handling their coins, I mean, if you've ever moved Bitcoin or Ethereum or anything on chain, you look and copy those addresses a million times. Like I'm pretty familiar with it. I always get anytime I move anything, I get very skeptical and worried about what I'm doing. And there's just plenty of people, like Michael said, that have full-time jobs and don't want to have to deal with this. So that's where regulation is going to come in for these centralized protocols or centralized people to really handle what is going to be needed. So I work in the traditional finance world, right? So I cover asset managers. I'm specifically an ETF analyst, and I cover this a lot from the grayscale side of things, the asset management side of things, and people in the crypto world who obviously I'm very interested in from a personal level are always like, why do we need an ETF? And the fact of the matter is people want exposure to this asset class, right? They want to know what's going on. They're going to dip their toes, but they want a safe and secure way to get access to that. So in the US, we have 25 to 30 trillion dollars under advisement from advisors. And advisors just aren't, for the most part, yes, some of them might get involved and get into the real DeFi sort of things and take care of client private keys or whatever, what may have you. But for the most part, they just want an easy way to get access to this for those clients. And those clients, maybe then they'll take the next step and really start diving in and how to do this stuff. but there needs to be practical, easy ways for people to get access to this to really understand how to use it and how to move things around on chain. It's not just going to be some clean jump from TradFi to using bank accounts to all of a sudden these people who don't know how to use Excel are going to be moving things around on DeFi protocols and using decentralized exchanges. So I think a lot of it is UX and UI and these different things, and we're probably many years away from anything like that. So I think there's a difference between what's practical here and what's idealistic and what the ultimate solution would be. Obviously, fractional reserve banking is a thorny subject here, but like that's just the world that most people are used to living in at this point. So making the jump from one to the other isn't just some easy fell swoop for a lot of people.
Daddy, did you have something to say? Okay, let's go with, I think it was KG and then Joe.
Sorry to interrupt. I just want to say something quickly because I'm going to leave in a second. I just want to touch upon something that James said. Is I completely agree with what he said, because the UI and UX isn't there yet because DeFi is so new. Then you won't have these institutions getting into crypto. And like he said, that a lot of these basically fintech people, they want to dip their toes into crypto slowly. So yes, we have some people getting into BTC and slowly into ETH. But even like the biggest crypto funds like Grayscale, they're very heavily into BTC compared to other altcoins. So I think yes, an ETF will benefit crypto hugely because they'll be able to access BTC from the safety of their own brokerages. But also just want to touch upon the fractional reserve banking. Fractional reserve banking is disagreed upon, but it works because there's bailouts by the government, and it very rarely occurs because people can't be asked to collapse a bank by withdrawing all their funds at the same time. But because there's bailouts and there's FDIC insurance, which is why it works. But with crypto exchanges, there's no insurance whatsoever. So it's because crypto exchanges, they are treated as banks, but in reality they're more like companies. They're firms. They're companies. They're registered as a company. They're not registered as a financial institution. If like these Revolut banks and stuff and these other like fintech banks, you have to get a bunch of licenses before they process fiat stuff. But with crypto exchanges are very easy and very unregulated currently. If you want to create a crypto exchange, pretty much anyone can create a crypto exchange. So I think the fractional reserve banking overall is shit, right? I'm not denying it's a stupid concept. I'm saying it does work in the modern world because yes, it's vulnerable to attacks, but at the same time it works because no one can be asked to withdraw, and if in the rare case everyone withdraws their funds from a bank, it'll be bailed out. With the crypto exchange, there'll be no bailouts whatsoever. We've seen this with every other exchange that's collapsed under pressure. But yeah, that's all I've got to say.
Hey, Yusuf, as always, thank you so much for coming on the panel, man. Your values are super necessary, and they provide a lot to the panel. Go ahead. Yeah, we can hear you. Okay. Go for it.
I think I'm bugging, so maybe I'll drop.
Okay, let's go with KG then while Theory figures that out.
Yes, thank you. And so yeah, there's a lot to unpack here from what everybody said, and I find myself agreeing with points from everybody. If you look at my profile photo, you'll see that I have yin and yang on my hat. And that's an important symbol because everything in life, there's two sides to the coin. There's the black and the white. There's the ebb and the flow. So in this case, I believe that is obviously CeFi and DeFi. And there probably is a place for both of them. But what Yusuf was saying, I actually really agree with that. He was talking about education. Education is arguably the most important thing. Now, obviously, we who are in this space right now are the crypto nerds of the world, and that's fine. I'm proud to be a crypto nerd. And so the education that it took us to become crypto nerds, you literally have to have a passion for this thing. So without that passion, right, some people just want to dip their toes in the crypto water. But what centralized exchanges are financially incentivized to do is to keep their customers ignorant. They're financially incentivized to say, leave your money here and trade it on my platform, which is it's almost an inherent corruptible factor, because if they weren't financially incentivized to do that, they would be, as the forefront of the crypto space, the most people interact with a centralized exchange before they ever get into DeFi. I know that was true for me. My very first entrance into crypto was on the Kraken centralized exchange. Well, not my very first entrance, but my first major entrance into crypto was through Kraken. So without Kraken, I may not have been as big of a crypto investor as I was in the beginning. So I'm thankful that they had that platform, that they had a clean UI, that it was easier for me to understand. But the exchanges, they don't educate their users. They don't tell them, hey, here's how you can actually get away from us because we are an inherent risk in the space. You could say that, oh, we will never reach mainstream adoption, and that you're probably right. We need better tools, more understandable tools, more approachable tools for the average person, the not crypto nerd. But those tools, that money, that infrastructure should be, in my opinion, obviously, geared towards DeFi tools. What if we had beautiful, huge companies investing in DeFi solutions that were on par with CeFi solutions? If you hold your money in an exchange, you are subject to lose all of your money. So what is the, and you're obviously subject in DeFi too. You could get rinsed, you can connect to a malicious DApp. Of course, the risks are still there. But at the end of the day, somebody can't pack the bags overnight, run away with your coins. And what was the point of getting into crypto if we just lost that person anyways? So
Right.
yes, I believe there's a place for both, but I think we're still heavily weighted towards CeFi, centralized exchanges, my apologies, and we should overall work as an industry to educate and migrate towards DeFi.
Yeah. I just want to add, actually, maybe not at par with CFI, but much better. That's the exact point. The thing is, everything since 1971, when we departed from the gold standard, everything is absolutely degeneracy. We are playing with monopoly money, and everybody's broke, and everybody's over leveraged ever since. And the nature in and of itself of the system is leveraging. The money doesn't exist, and they just send you hyperinflation money, because that's what it is. In the best of cases, you have hyperinflation in slow motion. In the worst of cases, it lasts a couple of months and then it's over. You know, but even if you go through what the centralized exchanges are, and I want to touch on that point. When it was said that it could be bailed out, so it's safe, it's not okay, because what a bailout really is the money is gone, and they're just printing more money. So in a nutshell, they are forcing everybody to chip in via inflation, and just that you don't have the choice. So on the one side, you have those who go bankrupt, and the creditors get ripped off, and everybody gets wrecked. In the other side, somebody does wrongdoing, gets bailed out, and everybody pays for it. So in a way, it's not okay either. And finally, even on and this is my point from the beginning. The traditional banking system is even worse, because you cannot do proof of reserves, because you'll figure out that nobody has them reserves. Even Elon Musk, when he's buying Twitter, you think he's buying Twitter just like out of his pocket with $40 billion in his pocket? Of course not. What does he do? He does the exact same thing as everybody else does, which is you have a bunch of shares, or AKA tokens, and then you collateralize them, and then you say, okay, so these are um, these are my Fugazi tokens in the case of FTX, and then they will collateralize on it, and then they can pump them. But it's like they set up their own price, so like it's absolutely degenerate. And the same thing goes with Tesla. I mean, I'm sorry, but the guy is going to be collateralizing his shares. I don't know if you saw, but a couple of minutes ago, or about an hour or so ago, he was saying that the Fed should lower interest rates if he doesn't want an apocalyptic scenario. Why? Because their shares need to go up, otherwise everybody gets margin called. It's racks on racks on racks. The problem is systemic, and it's systemic in the traditional market. It's systemic in the crypto market. With the crypto market, at least you can have a proof of one-to-one, where you have it not on the second layer, on the first layer, and you have it on the decentralized public protocol. You can do that. In the other market, you can't. So the biggest elephant in the room is, if we start once again, if we start questioning the reserves on the decentralized version, we might start questioning the reserves of central, and the entire fucking charade is going to go off. That's why they want to regulate, right? So the conclusion I'm trying to get here is, when you have $100 billion of whatever fugazi you have, and you start spending, let's say you spend 30 billion here, 20 billion here, you think you only spend 50, you have the other 50, but then when you have a drawdown of that collateral of 80%, you get margin called, and everybody gets wrecked. So, and this happens when you collateralize with your shares in the normal market, and this happens when you do it in the DeFi market. Difference is, when you do it in the crypto tokens, which are already like backed by absolutely nothing, not even ownership of a company, then it happens much faster. But it's exactly the same thing. By the way, I have to go in 10 minutes, but it was really cool to share this thing with you all. I'll stay for another 10 minutes, and see you guys.
Yeah, well, it's been great having you on. Thank you for sticking around. Joe, you're next.
Thanks. A lot to say. I think going back to the original point I wanted to make was like 3 or 4 speakers ago was Yusuf when he was talking about accounting. Yeah, listen, accounting 101 principle here, right? You learn it as an 18-year-old in business school is, how do you do accounting? Lower of cost or market. Guess what? When you mint the token and its cost basis is 0, it should always remain on the books as a 0 cost basis item, no matter how much the market gives it a value. Okay, that's what FTX did wrong. And listen, you're right. These kids, they were children that were running this company, are absolute Neanderthals. I agree with that. And because of that, they inflated their books. They got big enough that other investors were interested, and they looked past the fact that the accounting wasn't done properly. I would have shot every single one of my accountants, metaphorically, of course, if they allowed that to go out the door, to investors and posited it that in that way, right? There's a reason that you learn accounting, you learn TradFi, you learn how to, basic business principles. And it's something that you really do need to stick with, when you do the books. For instance, when our team does the books, and I'm part of the team that reviews and it reviews the books every quarter before it goes out to our membership, we make sure that every asset is properly accounted for, right? Whether it's fiat, whether it's a token, whether it's, any of that kind of stuff, right? It doesn't matter, but it has to be properly accounted for. That's number one. Number two, yeah, I guess we can always say that all banking, just to comment on some other stuff, all banking and all industries are a facade. Sure, of course they are. But, just because we arbitrarily had a gold standard before that and we made a precious metal and deemed it to have value, right? That we can also say it's a facade. So it's really, how far does that go, right? We can't have no economic and financial system in the world. We can't have it all collapse on itself. So there's got to be some kind of standards and protocols there. So yes, absolutely, regulation is vital for that. As most people were saying here, because if we don't have proper regulation around that, then we do fail. And lastly, to address the DeFi arm of things, yeah, you're right. I think it does need to be on par, not just on par with, but I think it does need to be better than CeFi protocols. And education. That was the big one I meant to get into as well. Sorry, I'm bouncing around. But lastly, our exchange has a whole educational arm, and I know other exchanges do this also as well, where we do educate about how to properly use a centralized exchange, how to properly keep custody of your funds in your own wallet, and how to actually use DeFi protocols as well. And we invest a lot of time, effort, and funds into properly educating our user base. I don't know if that's the same across all exchanges, but I do know that the big ones do run it. If you look at Binance Academy, they have a ton of material. We work with Blockchain Academy to develop courses on not just crypto, but blockchain and protocols around it as well. And myself, personally, I'm a lawyer. I teach continuing legal education, and I've done it in about 15 to 20 states so far in the U.S. on cryptocurrency and blockchain. I also teach at business schools, undergrad and graduate, and I've even taught high school courses as well on the principles around crypto. And it has nothing to do with centralized or decentralized. It has to do with the principles of understanding the basis of it and understanding it from a legal and business perspective. So that's not true when, it's just blatantly not true when you say exchanges don't educate their user base, because we focus a lot of our time on doing so. And, Noah can back me up on that as well, because Whalecoin Talk is actually one of our partners where we are working on the educational arm. So I just want people to understand that.
Okay, I would like to echo this speaker's sentiments as well. I totally agree with what he's saying. However, centralized exchanges at the moment are a cancer for the crypto industry because they are not educating people to tell them that the whole point of decentralized finance is it has to be permissionless, trustless, and centralized exchanges are nothing but middlemen. That's it. We don't need them, and we need to regulate against them so that they disappear off the face of the earth. Now, there is maybe a function right now for centralized exchanges because of the problem with fiat on and off ramps. But I would like to address the real elephant in the room here, because you guys are all very well educated and very well up on what is happening in the crypto industry. The biggest elephant in the room right now is the Biden administration frantic efforts to deliver a US dollar centralized digital currency. Now, the framework of such has to be such that we do not end up in a situation like the Chinese population. And you might say, how could that ever happen in America? It will happen unless you get involved. The framework is protected by the Constitution, the First Amendment, free speech, the Fourth Amendment, privacy. But unless you actually voice your opinions, they are going to bring in a currency that is forced upon you, which will allow the government to surveil you and to control you even more than what you are now. So please, can we also bring into this conversation the fact that everyone here who is educated enough to understand, go and poll your congressman. Make sure you understand what is happening right now underneath your feet regard to this central bank digital currency. It is the most important thing that is going on in the crypto world right now. Forget about centralized exchanges. Forget about the new regulation that's coming in. Forget about SBF and FTX and all that. That is a sideshow compared to what is actually going on right underneath your noses.
Wow, Conrad with the truth bomb. Let's again, lots to unpack here, but I want to jump to KG and Conrad. If you don't mind muting your mic for me, I'm getting some feedback on your end. But welcome to the panel.
So it's actually cool to get Joseph's perspective, being that he is the founder, I suppose, or at least core member of his own centralized exchange, right? Because we have a perspective from somebody who actually has an intimate relationship with that side of the industry. I guess going back, and Joseph, I do want to ask you a question, but I want to also, again, going back to the topic of proof of reserves, are they enough? All this said, I don't believe they are, because, the other points that Joseph was making, but also one thing that we haven't spoke about yet is, even if we show proof of reserves, do these, and Joseph, this is part of my question to you, do centralized exchanges leverage against their reserves? Like, do the entities go out and get loans against, like, hey, I have 10 Bitcoin. I show that I have 10 Bitcoin on paper. I only have 10 Bitcoin worth of clients, but I'm going to go get a loan that's valued at 5 Bitcoin. Does that exist on that side of the industry?
It exists, but personally, on our balance sheet, we have $0 in loans and $0 in anything long term, and the only short term things we have are partnership payments that we make monthly in fiat, mostly in fiat. Some of them in USDT or USDC, and that's under 20K a month. So yeah, we keep no loans on our books. We run everything by the book. So I can't speak to what other exchanges do, but I can tell you that we've never taken a loan out in our history. How we formed was actually an interesting story. just real quick, was that there were old founders of the exchange that did an ICO in 2018 and then really kind of absconded with they let the exchange collapse, never went past beta. I was outside counsel for the exchange, and myself and a few other contractors said, we're not going to let this happen to our potential user base. There were about probably 2,000 users at the time. We did a 1-for-1 free token swap, raised money internally, under $500,000, and got a contract with Binance through our industry connections for liquidity, order books, things like that, right? As a Binance cloud white label. And after that, we've worked since. Haven't performed another raise, just, done everything properly by the book. Never, like I said, never touched customer funds, never taken a loan out. And I think the closest thing that's ever come to a loan was myself helping the company out, buying tokens OTC at a premium and putting those funds into company operations instead. So yeah, we've done everything extremely proper, and that was small. That was like maybe 50K of funds. So we've done everything by the book, everything properly, and I'm very proud about that, right? And I think that comes with the territory of myself being, transactional M&A regulatory lawyer since 2008, and understanding, that this stuff needs to be done properly, and not being some kid like SBF and his compatriots, and 20-something-year-old who thinks they're contrite, they're smarter than the industry, and they're the smartest person in the room. There's got to be a level of humility and a level of approachability and relatability to people coming into this industry. Because, when I came in 2013, I remember how hard it was. We all remember. And it's something that if it's not approached from that perspective, it can be extremely damaging. And I think I'm glad you asked that question, because it's the overarching way you have to look at it.
Well, and so with you not taking loans, thank you for answering. Thank you for the transparency. But the fact that it can happen, and probably does happen with other exchanges, that one fact alone, there are more, makes proof of reserves practically irrelevant. Because everybody that uses centralized exchanges, maybe yours is different. I can't speak to every centralized exchange that exists, but at least the vast majority of them, that all the ones that I know of, let's put it that way, all the ones that I know of, you are an unsecured creditor when you deposit your crypto assets into the exchange. If you have actual real world creditors, if your exchange goes under, they get paid back, not the people whose assets you're holding. So even if you have proof of reserves, it really doesn't matter in most cases. And then my second follow-up question to you is, why do you have a token? What does your token do? Why do exchanges need a token? They seem only nefarious.
Sure. And I think that's a good question. We have a token because the old owners of the exchange, I don't think nefarious is the right word. I think what you do with it is proper. Like I was saying before, is important. Lower of cost or market, right? We always keep ours as a zero on the balance sheet, so we're not doing anything with it, and we've never lent it out or loaned against it. And I also think you're right. It's important to go back to your first point. It's important to keep no creditors on the books, right? Of course. Because then the actual deposits, which I talked about before, they actually go, when they're deposited, those assets go into a designated Binance wallet that we have, that we don't have access to, and we can't spend from, and we can't touch, and we don't want to touch, right? They sit there, and then they're used for withdrawals and deposits only. There's a segregated withdrawal and deposit wallet, so we can always prove that it's one-to-one, and we're not doing anything with any. That being said, getting back to your second point, I don't think the token itself is nefarious. As long as you develop functionality around it, right? We, in our year and a half, and we're about to launch part of and we think it's important. CDFI is important. We're about to launch part of our DeFi and decentralized ecosystem as a centralized exchange. So here's the thing. We understand that they work in tandem and they're harmonious with one another, and not everyone wants to transact on the same platform. So that token, you develop functionality around a true utility token, whether it's rebates, whether it's rewards, whether it's staking, and when I say staking, it's single asset staking with no lending on the back end. And it's just staking our token and locking it up for a period of time to earn, an amount of a dynamic amount of liquidity, not a static APY. So it's based on trading volume. So it's that kind of incentivizing that is proper for a token, not propping up prices, not, driving a market with it. No, the market bears what it bears, right? Even with our token swap, we could have minted a new token and done a new ICO, but we decided it was important to not disenfranchise customers and to keep goodwill for customers and users of our exchange. And we've built that user base from about 2,000 into about 70,000 active users now, which is, a sizable growth in a year and a half. But we do it the proper way. And I can't speak to, like I said, I can't speak to other exchanges that don't do it that way, because I've never been honestly raised or taught to work that way, right? And I instill those values with the rest of my team, and the rest of my team's completely on board with that too. So I think it's really case by case, and it's really like going back to the beginning. It's as good as the trust that you instill in the team, right? If you've shown to never be a bad actor in this industry, and I was a lawyer in this industry with my own firm, just a little background, in Denver, Colorado since 2015. So I've helped like probably 60 or 70 companies at this point, from startup stage through ICO and after, right? So working in that lens, I've been in the industry for a long time, relatively, and I've seen it grow, but I've also always tried to do the right thing to make sure these companies stay around and stick around. And I won't take on companies that seem scammy. I won't let my firm do that. And it's important to instill those kind of ethics in the industry, whether you're running an exchange or being a lawyer or helping draft regulation. So I guess that's my comments on that.
And that's fair. Okay, see, if you're utilizing that token for exchange fee rewards, right, and not promising like these ridiculous, hey, 8% guaranteed, lock up your Bitcoin with that type BlockFi stuff. We see what happens in those cases. And actually, just to give a little background so you understand where my perspective is coming from, I'm actually the founder. We're building a crypto wallet, and we are the first tokenized wallet of its kind. And look, I'm not going to go off on this whole shill. I promise that this has a point to exactly what you were saying. So we've introduced a token for our wallet that is directly correlated to the fees that are incurred within the wallet. So if your token has a revenue based model, I believe that's a beautiful tokenomic. And I know you said you're still working out what you're going to do, but if you aim to do that with your token, that right there could set you apart from other CeFi tokens. Or sorry, yeah, CeFi, yeah. No, centralized exchange. I don't know why I'm saying CeFi. Sorry, I can't. Yeah, but yeah.
I conflated.
Yeah,
no, just to get to the point. Our token's been around since 2018. It's been active on the exchange since late 2020. So it's not hypothetical, but yes, we are building out the DeFi side and the decentralized side of it for the staking that's going to go live in a couple of weeks, and rewards within our DeFi and DEX ecosystem as well. So that's why I think that's what I was commenting on. It's been live on the centralized side since December of 2020, since we launched our exchange and went live. But you're right. I mean, tying tangible functionality into it and utility instead of pumping market prices and doing such. That's what a utility token is supposed to be anyway, is keep building functionality. And that's what we've been doing through this bear market, and that's what companies should do. So I 100% agree with you. And good luck on your token, by the way.
Likewise.
So DeFi Centurion, welcome to the panel, man. I see your hand up.
Hey, yeah, thanks for letting me up. Just a comment, and really quick. I think one of the things is, with how much damage that centralized exchanges can do and have done, there needs to be really full transparency. The standards of transparency need to be there. Absolutely. The other thing too is accountability. We see in the situation now with Sam Bankman-Fried that there is no accountability, personal accountability. And when it raises at that level, there has to be some form of personal accountability. There can't be hiding behind the corporation. This is insidious. So I just wanted to make a comment that we should be talking also about self-enforcement and transparency within this industry. And that's my only comment.
Yeah, I think a lot of people are seeing that so far nothing has really happened with Sam, but also building up a case against an individual takes time, and so I'm waiting to see what actually happens. I do believe, I would hope that he is held accountable to some degree at the very least. But and if he's not, then I think it would not instill much trust back in these centralized exchanges. However, I wanted to I don't want to harp too much on the nuances of the case. I wanted to bring it back to the proof of reserves, and obviously a lot of these exchanges that have released their initial proof of reserves have said they have more assets in other places. I don't really know where those other places are. It's kind of it's questionable, and a lot of them have not released their proof of liabilities, which is very important. Again, proof of liabilities are the customer exchanges, or excuse me, the customer assets. Um, one of the things I noticed, Joe, and I'm directing this at you as a CEO of Mandela. By the way, just to retouch on what Joe said, Joe's done a lot of great work educating the youth, whether it's in high schools and colleges, making courses on crypto assets, not centralized exchanges, but just crypto assets, why crypto is important, all that good stuff. But this question is towards you, Joe. It's a bit concerning to me at the very least that I see a lot of these centralized exchanges holding USDT as a standard stable coin, and some of them holding quite a bit of it, Qcoin being one. And I'm is that a problem if right because USDT has gotten so much regulatory scrutiny there's I don't know how much of it's FUD, how much it's not, but is it a problem when we see that the main stable coin that many of these sexes are using or rather holding their reserves in is one that might not be so stable?
Well, yes and no, right? People have tried to depeg USDT before, multiple times. Hasn't worked. Why? Economies of scale. To depeg properly USDT, quite honestly, you're going to need to take a hundreds of billions of dollars risk if you're going to really go after it and really depeg it because of its market cap. And also because it may not be backed one-to-one. That's where the yes comes in, but it is mostly backed by fiat currencies and short-term notes that can be called in a moment of in a moment of need, right? So let's look at the bigger market implications. If somebody does successfully depeg USDT, and now would be the perfect time, weakened market conditions and a lot of skepticism around crypto in general, right? Now would be the perfect time. You're not going to do it in a bull run for obvious reasons. People are going to be using it more. It's going to be a lot more volume, and there's going to be more need for it, right? That would be suicidal risk to take, and I don't think anybody wants to take on that risk on the books, quite honestly. But if you're going to do it now, you could go after it, but you'd need, like I was saying, probably hundreds of billions of dollars in loans to really successfully go after it. The reason it worked with Terra was not just because of the algorithmic peg, but because it was a small market cap. There wasn't a lot of reserves behind it, right? You gotta flesh that out, economies of scale. So what institution or group of institutions is going to take that risk right now to destabilize a market like that? And if they fail, have all that money out there that they've spent on a failed attempt to really destabilize crypto. And I know the conspiracy theorists and some people here are going to say, oh, governments are going to do it. They're behind it anyway. That's a really big risk for any government to take right now, especially when dollars are hyperinflated or currencies around the world are hyperinflated, as we know, over the last couple of years. So I don't see it happening. I don't think the risk reward is worth it because it's not going to stop people that are in the market from using crypto. They're just going to switch to another stable coin if they do. Some will exit, of course, but I just don't see the risk reward factor. Just my thoughts on it.
KG.
Yeah, so that's a great question, Noah. And Joe, I hear your perspective on that. I think we have to be careful by saying, oh, hey, hundreds of billions of dollars, because that almost makes it seem like it's secure. And maybe you feel like it is, and it might be. But we also have to look one layer beyond just the finances that back the stablecoin. There's also technology that makes the stablecoin stable. We have arbitrage bots that buy the price up and sell the price down. What if they stop the arbitrage bots? What if the arbitrage bots get compromised? You can compromise things even without the actual financial backing being compromised. And yes, Luna is a great example of where algorithmic stablecoins can be bad. but the tokenomics of Luna were just bad, and then you had bad actors in there as well who acted badly, because that's what bad actors do. I think one good protocol to look at and it's relatively new-ish. I think they've been around for maybe a year-ish time. Is a protocol on Ethereum called Liquidity, and they're an algorithmic stablecoin. And the only collateral that they have is ETH. And it's like a loaning system, but it's all a smart contract. It's all immutable, right? So it cannot be changed. There's no admin keys. It just works. And all the parameters are built into it, and they have all the fail safes. Now, of course, no blessing is curse free. There's probably some failure mechanism there as well. But we have people deep in our community who put a lot of thought into philosophically and theoretically trying to think about ways that these protocols will break, and still yet, and I'm not, again, we could very well be missing it. We're humans are fallible, but it seems that like Liquidity, if you look into that protocol, I believe that right there could be the future of stablecoins, because USDT is completely and utterly centralized, and there are many modes of failure. The only real security it has is that it's so big and that so many companies and protocols are reliant on its success. It has like the common support. So I guess that's its biggest strength.
Another question I had with respect to proof of reserves and proof of liabilities, and again, this is directed at Joe or anyone else that knows the answer, is this something that is cryptographically verifiable every second of every day of every month of every year? Or is it something that's published at the beginning of each month, and then, realistically, bad actors could engage in whatever shenanigans they wanted, and when it's back, as long as it's back in time for the next publishing?
For us, it's at any time, because all user deposits go to one wallet, on our exchange that we literally don't have the keys to and don't want to have the keys to, right? It's a deposits and withdrawals wallet that is a Binance infrastructure, Binance secured wallet, and it is backed by Binance's, SAFU policy, which more than covers, in the event of a hack, more than covers deposits on our exchange, at least. And obviously we've never even had an attempt at a hack, so I don't know. If I know it's back, but I don't know how the protocol would work, but I'm assuming they would just replace user funds based on snapshots that are taken there. But you can check that wallet at any time, right? It's not a it's not a mystery. It's published, and for us at least, it can't be messed with, because we wanted that hands-off approach, and we wanted to be good actors in the industry. So for us, it's just right there, and it's accessible.
So one thing I'll say, and take it with a grain of salt, everybody, based on my research, Binance seems to have in my opinion, the most robust proof of reserves, that being, I think 30% is held in BUSD. A lot of people are under the impression that BUSD is minted by Binance, right? They say, oh, well, they're just collateralizing, or they're holding their own stable coin. That's actually not the case. BUSD is distributed by Paxos, which is the most regulated and heavily regulated stablecoin issuer in the United States. So it's something to consider. And I've seen other exchanges where the reserves that they've printed so far, that they published so far, are questionable, right? And I don't want to call out KuCoin, but again, I consider myself still a beginner. My 5 years in this industry, but the fact that they're holding 20% of what they published so far, of their 2.5 billion of reserves in KCS, their native token, is a bit concerning to me. So I think that even if an exchange publishes proof of reserves or proof of liabilities, don't just read the headline. Go and see what those reserves are made up of, because that's very important. KG, go for it, brother.
Well stated, Noah. Well stated. And yes, you're absolutely right about that. In that case you just described of KuCoin, it's like, sure, anybody can make tokens, and most tokens don't have intrinsic value. So what, my opinion, a token with intrinsic value is probably the native coin of blockchains. Right now, they're obviously volatile and they fluctuate, so we can't necessarily call that stable. But beyond that, any token that anybody creates, you have to like build some form of intrinsic value around it. So, like you said, with KuCoin, 25% of their reserves being this token they poofed out of thin air with no intrinsic value, that is a risky situation to be in.
Just to be clear, it's 18% of it. So their grand total of their balance sheet is 25 billion. And that's 25 billion to 20 million users. And that's another thing. The ratio of holdings to users is also important to look at. But it's only 18%, KG, just to clarify, that is made up of KCS. But nonetheless, it doesn't really, I mean, they have their own chain, I think. I just finding this out. But there's not much utility in contrast to Binance's BNB, for example. Sorry, continue.
Okay, fair enough. And then, no, thank you for clarifying. I like to get things factually accurately correct. So I appreciate that clarification. And then my final thoughts on the proof of reserves would be, even if we knew every wallet that the exchange was using, and we saw every fund go in and out, exchanges often, like in the case of Binance, there's no way they're doing one wallet that has all their stuff come in and one wallet that has all their stuff come out. That's security risk written all over it. So arguably they have to have multiple wallets, probably dozens, countless wallets, money moving around all over the place. So even if proof of reserves was, hey, check the chain, it's still going to take a high level chain analyst to comprise this data, and then you're still trusting the chain analyst anyways. So arguably, there's probably no real way to ever truly and fully verify the proof of reserves are accurate or real.
And I think that goes back to what Michael was saying at the very beginning of the space. Michael, from CEO of Shrimpy, had to drop out, but he was basically saying that at the end of the day, you can't really confirm every single last reserve, and you need a centralized entity that you can trust, that has a reputation, that has a track record. I mean, Joe has also touched on this throughout the course of the space, but is also going to be held accountable from a regulatory perspective. And that is the trajectory we're heading on, especially with frameworks like MiCA coming up in Europe. Hopefully the US, we get it together sooner rather than later. I want innovation to stay in our country and continue to thrive, but that's a tangent in itself. I mentioned one more thing that I want people, audience members, to keep an eye on, and it's the ratio of reserves to users, right? And I'm going to call out crypto.com here. I'd be happy to be corrected on this, but their grand total of reserves, which is, as most exchanges have said, is not all of their reserves, is 3 billion to what they claim to be 50 million users, right? That ratio, just for some context, Binance has 68 billion POR to 30 million users. So to me, that kind of raised the flag. I'm not really sure what's going on there. It's something else to consider. But I mean, this has been a great talk, and I'm going to let my teammate Acti here close things out with some final thoughts. However, before I do, my personal opinion, again, nothing on here is to be taken as financial advice. I know that an attorney came on here once and said, just because you say not financial advice, it doesn't mean you can't get financial advice. I don't know how it works. So I'm gonna say it anyway. Not financial advice, but I'm in the sentiment, rather. I'm in the philosophy of KG and a lot of others. Joe probably shares this to a certain extent as well. That I like to have ownership of my own assets. I consider myself hopefully competent enough. I mean, again, I'm only human and I probably can make mistakes, but competent enough to store those safely. There is a part of me sometimes that likes the idea that if something would go wrong, I can turn to a centralized entity for help, but we're not there right now. So does that mean that decentralized exchanges are going to take over due to transparency issues? I think that the ceiling for decentralized exchange use is very high, and we have yet to reach that. But ultimately, I don't see us living in an entirely decentralized world, because that is just not it's not how humans behave. It's not how humans interface. So that's my opinion. I would love for us to go full decentralized, but I just don't think it's going to happen. Although I do think that the decentralized the DeFi market share is going to increase by substantially, especially with younger generations coming up and having an easier time learning this stuff. I definitely think there's room to grow, especially with wallets like Phantom and order book dexes like GMX on the rise. We will see an improvement in these technologies. But for the time being, I would say, audience members, if you can. If what I'm doing is I'm limiting my use of centralized exchanges, even ones I really trust, ran by people that I have a lot of respect for. Personally, I'm just using them as fiat on ramp and on and off ramps. If you want to trade large volumes, that's fine. But try to educate yourself on how to use a cold storage, how to use a cold storage wallet, right? How to store your private keys safely. At the end of the day, the people, I know that you can make arguments for both sides. People that got wrecked recently are the ones that thought they could keep their funds on FTX. Anyway, that's my rant. You're about to come in with another, Act is about to come in with another rant. But hope you all enjoyed this episode today. We kept it relatively short compared to previous ones. It's not something that I want to go on circles with too much, but more topics and thoughts that I found interesting to unpack. So, Acty, the mic's yours, brother. Close it out for us.
Thank you so much, Noah. Yeah, it's not going to be so much of a rant as more of a sum up of what people have been putting out for us, and this has been a very, very interesting space. So, starting off with Michael, he kicked it off like really strong. The number one point of failure is people, and I completely agree. And throughout the panel, we've been talking: is regulation the answer, or more regulation the answer? I personally don't know. And of course, KG still here with us. He's always there telling people, use a sex like a sex. It's not a bank. If it barks and it behaves like a bank and all that, it doesn't mean it's a bank. You got to be a little bit careful on that side, right? And the Yusuf came in super strong with going back to the roots. I know he's a big decentralization fan, and I think decentralization is the way, but you need to teach people how to be exposed to risk, how to manage these assets, how to deal with sexes and all that. And I believe that, well, the topic is proof of reserves, and I believe it was Thierry that made a great point that proof of reserve without proof of liability isn't much, and then you got to go a little bit deeper, right? You got to look at the transparency. How transparent will it be? Is it going to be on a public blockchain? When are they taking the snapshots? Is it going to be, I don't know, a quarterly thing? Are they going to do it every minute? Is it going to be a weekly thing? You got to look at everything, right? And then even further down, I think he was going down the path of if are you accounting the discount for risk. And well, I think Thierry was a little bit harsher than I am. I think, well, his point was that the standard banking isn't good, and going as far as calling everything a shitcoin, I think is taking it a little step. I don't know, and yeah, in not a direction I'm comfortable with, but self custody is the way. That's for sure. You know what you're risking, you know how much you're leveraging, and we got people like Joseph is still here. Thank you for joining, man. It's like we need people that are good lawyers, lawmakers, people that can work with these regulators to sort of build something that's sustainable, right? Because CDFI is here to stay. It's not going anywhere. It's not me saying it. It's not Joseph saying it. It's not CZ saying it. It's the market saying it. Look at the market. Look at the people using it. So it's clear that people want to be exposed to this. And I don't know, was it James or who was it here that said he had to deal with a lot of these people that were basically saying, I want the exposure, but I don't want the hassle of being responsible, essentially, right? Which is a little absurd to me, but I guess, yeah, people want to be exposed, but they want the safety too, and then yeah, but we had some interesting panelists join. I don't know, was it the guy Conrad, who was it, that was completely against sexes and thought we're completely evil and wanted us to steer away and just talk about CBDCs. Now that's probably something for a different panel. And well, on a personal note, I won't be joining any of the NSA chains or Fed chains or anything like that. So I really hope that people are walking away with more answers than questions from today's AMA. I know personally I am not. Like, I've written a bunch of stuff down. I'm gonna have to go look back through it and see where I stand and what's going on. But I think this next year, 2023, is gonna be a year for the builders. Same as 2019, and the second half of 2018, and we'll see the same thing. People that are building, people that are excited about the space, people that want to engage, they're still going to be here, and it's pretty obvious that everybody wants to be involved. I've seen articles pop up again, like we've seen after every cycle, crypto is that, crypto is this, crypto is that. And no, it's not. I'll tell you, like, on a more I don't know, silly note, crypto is a place where people with experience meet people with money, and at the end of the day, the people with money walk home with experience, and the people with the money the people with the experience walk home with the money. So the more you understand the space, the more you engage with it, the more you go back to the roots and really understand where it's all coming from, the better you'll do. There is no magic pill. I've been saying this for years. My track record of onboarding people to crypto, even close friends, is one. I've only managed to get one of my friends, and I've been at it for 10 or 11 years now. So I don't know whether uh, regulation is gonna come faster than education, but I agree with Yusuf when he said, education before regulation. I'm all for it, but education, I feel, is something that's the hardest thing to do in this space at the moment. We're all trying it. We're all trying to expose people in a safe way to everything that's being put forward, and trying to build a good system for everyone. But only the future will tell. So I'm glad everybody joined in, and this has been tremendously amazing. Like, I've had fun listening in, and thank you everyone for joining, and thank you, Noah, for hosting. So that's just my final thoughts. If anybody else wants to come in and end this on a bigger bang, you're more than welcome to do so. But I've had a lot of fun, and we do these for anybody that's just tuning in and listening every Wednesday for UTC. Tune in, and we have different topics. We try to bring industry experts. We try to bring people that are at the forefront of this technology, and really discuss it and see how they feel about it. As you've seen today, we've had some polarizing ideas, so we're open to everything as long as everyone's being respectful and keeping it at a civil level. It's all good. Everyone's welcome here. So that's just my 2 cents. Now I'll pass it back to you, and I believe KG wants to go. Just go for it, man.
Yeah, KG, go for it, brother.
I know we're trying to end the space, and I didn't catch your name, who just spoke, but excellent words. And again, I want to say thank you to both of you, to the Whale Coin Talk, for giving me the opportunity to jump on today. It's a true honor. And my final thought is decentralization is a spectrum, and we're coming out of centuries, lifetimes, all of humanity from centralized aspects of finance and commerce. So it's a spectrum. As long as we take continual steps towards education, protection, and tools to make decentralization more and more possible and accessible, that's what I'm here for. So again, thank you, everybody. Excellent words today.
Yeah, I couldn't agree more, KG. And that is my teammate, Acti. He's phenomenal. He's we're all working together to build Whale Coin Talk in the Aquarium. Guys, thank you so much for joining today. These episodes sometimes go for 3 hours, or 4 hours, like they did last week with the Twitter discussion. And sometimes we get what we need to in 90 to 120 minutes. But the Aquarium episodes take place every day at 4 p.m. UTC. I typically just go with a hot topic in the industry and bring on panelists, and we discuss. Sometimes it's heated, sometimes it's pretty tame, but it's always really educational and fun to listen into. So if you have ideas, shoot them over to me. I've come up with a few ideas just from this episode alone. I think it'd be fun to do one on CBDCs. I think it'd be fun to do one on really the nuances of DeFi versus CeFi, rather decentralized versus centralized. But yeah, if you want to be a part of the panel, shoot us a message. If you want to be a sponsor, shoot us a message. We're happy to talk to anyone and everyone. Thank you all so much for joining today. Thank you, Acti. Thank you, Whale Coin Talk, and thank you to the beloved panelists as well. Shout out KG, Joe, and Anthony for staying to the end. Appreciate you guys. Take care. Bye bye.